All right, it is April 17th of 2023, and we're going to go over Tracy Suchart's Energy and Materials of the Week. And you're going to get more bang for your buck, literally, because we're going to go over the USD, US dollar. We're going to go over oil. We're going to go over real estate. We're going to go over gold and some other gold, copper, and some others. There's just a whole lot there's a whole lot of value in this. So we're going to go through today. My name is James. This is James in the Giant Economy. Thank you for joining in. Remember to like and subscribe if you like it. Even if you don't, just give me a shout and say thanks for this. And if you are on my email list, you will get this chart yourself. Something I pay for that you do not. All right, let's jump in. The death of the USD. There's lots of talk about the death of the dollar over the last few weeks as Total Energies purchased cargo of LNG and yuan from China. China is making deals to trade in yuan, that is the Chinese dollar, and Russia is exploring other currencies to trade oil in due to sanctions. I believe these calls are very premature. To be a reserve currency, you need 5 things. So Tracy's saying, hey, here's the 5 things we need to have as the reserve currency. Let's identify them and go through them. Trust in the central bank, right? U.S. Federal Reserve is one of the most powerful central banks in the world, with the U.S. dollar used for approximately 90% of all the world's currency transactions. The Fed's sway has a sweeping effect on the valuation of many currencies. In addition, the bulk of the U.S. dollar reserves are held in the form of U.S. Treasury securities, which are in high demand by both official and private foreign investors. As of the end of the first quarter of 2021, $7 trillion, or 33% of marketable Treasury securities securities outstanding were held by foreign investors, both official and private, while 42% were held by privately domestic investors and 25% by the Federal Reserve System. So, what is she saying there? If you're going to be a reserve currency, you need to be trusted, right? People aren't going to worry that you're going to mess up the currency. You're going to devalue it somehow, right? Now, I know in the last 2 years, the U.S. has not been very good at that, right? But for the last 30 or 40 years, they have been pretty decent about it, at least better than all the other currencies in the world, right? And so what she is saying is 90% of all the world's currency transactions is held by U.S. dollars. In other words, let's say you are doing business within the country, we'll say China, okay? And they're going to pay you for something that you own, right? So let's say you export metal, and China's saying, hey, we need a lot of metal to build these skyscrapers and these dams and these highways or whatnot, right? Or whatever. They're going to buy that metal from you. And what are you going to say to them? Are you going to say, hey, okay, you can send it to me in yuan, right? Or in Chinese dollars. You're going to say, no, we need US dollars for them. Okay, so the Chinese company is going to take their yuan, transfer it to US dollars, and then pay you, right? Or what's most likely going to happen is you're going to say, hey, cool, we're going to send you, a ton of metal, like 10 tons of metal per month. And you're going to pay us this many dollars, right? And you're going to agree to that for the next 10 years or, year or 2, right? Because you need metal slowly. You can't use it all, and we can't give it to you all. But so in the sense, they're going to go into U.S. dollar debt for you, and you're going to go into metal debt, right? So what they're saying is that the majority of all the transactions in the world, the majority of debt in the world is not denominated in gold, it's not denominated in yuan, it's not denominated in the British pound, it's denominated in the US dollar. This is very important because you have to get dollars to pay that back, right? They're not going to switch and say, okay, yeah, you can use yuan or you can use pounds or something like that, right? They're going to use dollars. And so you have to buy those dollars back. You have to trade a resource in for them. That gives more demand to the dollar, thereby keeping its value raised high, right? A lot of people have said, YouTubers, everyone's saying it, that, hey, being in the U.S., we are very, very lucky just to be the world reserves currency, or else we would not be where we're at today. And they are right, because being the world reserve currency comes with the perk of always being in need. Being in need raises your value, therefore the currency value the currency will have value, right? Printing more dilutes that down a little bit, but currently it's still the best one in the world currently, right? Or in other words, like say, it is the biggest toddler in the playpen, or some people have said it is the cleanest rag in the dirty clothes hamper. Okay, so she says, hey, we need trust in the central bank. Right now, the U.S. dollar has it, and not only but trust, but they have debt into it as well. And again, most of that is 33%. So 1/3 is held by foreign investors. 42% is held by private domestic, U.S.-based investors, and 25% by the Federal Reserve System. Okay, so you've got 75% of it held by individuals in the U.S. or outside of it, with 33% of it being held outside the U.S. That is a very strong position to be in, and it's going to be one that's going to be hard to take down. Will they be able to take it down? I'm not going to say it's impenetrable. Will it be this year, next year? Probably not. Could it be in 10 years, by 2030? Possibly. We're all going to find out together, right? Here she gets a chart. We're just going to go past it. Here's a really good one. Foreign holder treasury securities. So it shows what country has the most treasury securities, right? Because a lot of times you'll trade back and forth as she talks. You'll hold the U.S. denominated dollar, your dollars, the value of dollars in treasury securities, so they pay you a small interest rate, and you can always exchange them back at any time. So in other words, instead of having a bunch of $100 bills in your vault, you just have, hey, the treasury owes me, 10, let's take Japan for example. In January of 2023, they owed the U.S. Treasury owed Japan $1,104.4 billion in treasury securities, right? So Japan's leading the way. China is second to that. UK is second after that. Is third. Belgium, Luxembourg's got some a mixture of European and Asian countries. I'll let you go through the list, but it kind of just goes down. The very bottom doesn't really matter, but they've got some smaller countries. But the point is this, is that Japan, China, where is Germany in there? Germany's kind of in the middle. These are the top three economies, right? The top three producing economies. The US, Japan, China, and Germany. They have, two of those have the most dollar-denominated bonds. Germany's got kind of in the middle there. So there's a lot of connection to higher economies that are doing very well. This builds a good stronghold for the dollar. Okay, liquidity markets. U.S. dollar has been the dominant currency globally. U.S. dollar has been the dominant currency globally is the strength and stability of the U.S. economy, as well as the deep and liquid financial markets that the U.S. offers. The U.S. has by far the largest bond markets and stock markets globally, and importantly, the financial markets are highly regulated and offer borrowers and lenders access to a large set of counterparties. These advantages have allowed the U.S. dollar to maintain its dominant position in internal trade and finance. That just kind of spells it out for you, right? Yeah, again, we're the largest bond. We're the largest kid in the playpen type thing. Spells it out. Wide acceptance. Most of the global trade is still conducted in U.S. dollars. The Federal Reserve estimates that between 1999 and party like is 1999 and 2019, the dollar accounted for 96% of trades in North America, 74% in Asian Pacific region, and 79% for the rest of the world. The only region where trade was not dominated by the U.S. dollar was Europe, where the euro remained the preferred trade currency, which is kind of self-explanatory. Global oil trade, which accounts for about 6% of overall trade, is still largely conducted in U.S. dollars. And this is from the Federal Reserve. All right, so what does that mean? So basically, and she cut it off at 2019. 2020 kind of throws some monkey wrenches and things, and we get that. But for that decade beforehand, the dollar accounted for 96% of the trades in North America, 74% of Asia Pacific, and 79% for the rest of the world. The dollar is the most widely accepted and traded currency. And you might ask yourself, well, why is this? Well, there's some other reasons, right? But the biggest thing is this: think about yourself as a foreigner, right? If you are a foreigner watching this, please put your thoughts in the comments section, okay? But if you are in the U.S. like I am, we think of like, what big deal is this? Well, other countries don't manage their financial system as well, or they don't really have a basis to, right? And so what they'll do is they will just print more money to try and either manipulate things or just relieve some pressure at the moment to make it hurt even more, right? Like Turkey and Libya are some great examples of the latter. The central bankers, they'll just print money and hyperinflate the currency, and literally some of them they will get lynched if the people find them, because the people are going broke. So what they do, the people, the individuals, when they get their paycheck in Turkish or Libyan or whatever currency, they'll immediately change it into one of two or three things, right? They'll change it into dollars immediately, right? So it holds its value. Or B, they will change it into gold, right? So it holds its value. Or number three, sometimes they'll go to Bitcoin or something else of like nature, right? It's always a game of trades, whether it's dollars to houses or dollars to oil or dollars to gold or dollars to yuan or vice versa. There's always a trade of value. And so in foreign countries, if you're getting high hyperinflation, you trade it over to another asset. In this case, they'll do it to dollars, right, to help protect that. And again, you can do that with $100, right? You don't have to. It's not like a house where you have to have hundreds of thousands, right? Or in the case of China, where the government constantly and consistently waters down the Chinese yuan, the Chinese dollar. They do that in order to make their exports more competitive, so to keep the country financially afloat, right? Because China, everything's made in China, right? What does that mean? That means they export everything. Okay, we send them stuff to build, they build it, they send it back to us at a price. Okay, and that price has to be low in a conversion, or else you're gonna pick somewhere else to go, right? If all of a sudden it costs the same as the U.S., well, heck, we'll just manufacture in the U.S., right? So they purposely have to keep their Chinese dollar low in order to keep competitive in the open markets. The dollar is still the strongest, and it's going to continue to be. None of that, but it is where people go for a sense of security. It still is, right? There is a small slight over change to gold, and we see that in the central banks as well. Bitcoin, we're not going to go over, but it's there is hope, but we'll see what happens. Okay, convertibility. I'll let you go over this chart. Currency convertibility is the ease with which a country's currency can be converted into gold or another currency. Currency convertibility is important for international commerce, as globally sourced goods must be paid for in an agreed upon currency and may not be the buyer's domestic currency. When a country has poor currency convertibility, meaning it's difficult to swap it for another currency or store of value, it poses a risk and a barrier to trade with foreign countries that have no need for domestic currency. A convertible currency is any nation's legal tender that can be easily bought or sold on the foreign exchange markets with little or no restrictions. Again, this is kind of what I've been talking about. It's easily convertible. There is value in it, and there has to be, the end buyer has to see value in what you're giving them, right? Whether it be dollars for milk, whether it be bartering for something at the store, or a neighbor for hey, I'll give you a cup of sugar if you give me a cup of milk type thing, whatever. There has to be value. Currencies are the same way. In America, we just see this as we don't see the importance of it because we've always been on the top with the dollar, right? But we're not very close to other countries, so we don't have to deal with it. Okay, we don't deal with currency in different states, right? We don't deal with that. And so Europeans, they get it like this because there's so much integral change of one country to another that, especially before the euro, you understood that, hey, the German dollar is worth more than the Greek dollar or something like that. In fact, this is one of the reasons why the euro dollar was invented. Excuse me, not the euro dollar, but the it just popped out of my head. The euro, was invented because instead of, you could use one source of a dollar, like have one currency in your pocket, and not 10 or 15 from the different countries, right? Or have to, when you're in the middle of bartering, have to ask, hey, what currency do you take? And that becomes another bartering thing, right? Okay. So Chinese yuan is a non-convertible as it's traded in low volumes in the foreign global exchange market and tightly controlled by government via capital controls that limit the amount of currency that can exit into the country. Yeah, that's another thing. A lot of people think the Chinese yuan is going to replace the dollar. I am not on that boat for several reasons, but the biggest thing is, bottom line, is their government control. Control in diluting it down, control in allowing it to enter or exit the country, most notably exit the country, right? They just won't allow it. They won't allow you to take it because they have control over it. And the third is because the Chinese have a whole lot of U.S. government bonds, right? Strong military. The fifth thing she talks about the need of to being the central bank or the central currency. Strong military. Over the last 300 years, there have been three major empires: the Dutch Empire, the British Empire, and the American Empire, each characterized by having a reserve currency and a dominant military. Let's take a step back. I know there are a lot of people saying that America is going to go to the pooper, right, after people break the dollar and stuff like that. And, you know, when people break the dollar, it's not going to be beneficial for the U.S., right? It's not going to help them or anything. But I was thinking about this, and you look at the Dutch Empire, the British Empire, and now in the current civilization, the American Empire, right? And look at the Dutch, look at the British. They were once the global big kids, as I said, in the playpen, just as the Americans are now. And their countries are doing decently, right? The Dutch and the British, they're not third world countries by any stretch of the imagination, but they have been dethroned. So I'm not super worried about America. I am concerned, cautiously concerned, or understandably concerned, I guess, keeping my eye on it. But I wouldn't be, hey, this is the end of everything, and, you know, sell everything and just go buy an own private island and stick your head in the sand. I am not for that, because Holland is a great place. I enjoy Holland. I've got some family that married in, actually. The British are doing fine. They wisely did not go into the euro. And I think America is going to be fine. I'm not worried about America because of the dollar. Let's put it that way. According to Statistica, the most powerful military in the world is the United States military. I think we all knew that. The top 8 most powerful militaries as of January 2022 is U.S., Russia, China. I think we all knew that. Then comes India, Japan, South Korea, France, and United Kingdom. Interesting. I am surprised Germany is not on there. Interesting. The 40 countries with the highest military expenditure in 2021 are as follows. U.S., China, all the ones that they just named. Then you get France, Germany, Saudi Arabia, Japan, South Korea. This is interesting and important. Let's go back up to here to the most powerful militaries. Okay, so you've got the U.S. as number 1. Okay, and I think this is the order. I'm going to assume this is the order. Then you have underneath you have Russia and China, which are forming kind of an alliance. Really, they are forming an alliance. Maybe not 100% on the same page as each other, but they're definitely seemingly going against the U.S., or there are those whispers in the wind of it, right? So you have that issue. Now, India is the 4th one on the list. I'm not sure where they're going to stand on international politics, right? They're kind of a wild card. Right now, they're leaning more towards China and Russia just because the BRICS nations. Japan is one of our allies, actually, one of the U.S. allies, and a close one. South Korea is a U.S. ally. France currently is more of a U.S. ally than not. The U.K. is a U.S. ally. Germany is a U.S. ally. So my point in bringing this up is that we're talking about military, we're talking about the dollar, and yeah, you know, World War III is on everybody's mind. If it was just the U.S. versus, let's say, Turkey, or let's say we had some beef with Turkey, right? They're number 18 on the list, or Brazil, 17, right? It would be kind of a no contest, right? If something ever happened, the U.S. would seemingly just step on Brazil or Turkey or whoever the lesser power was, right? But right now, you have the number 1 superpower and the 2 and 3 kind of teaming up against him, right? So what do you do when that happens? You go to your allies, right? Because World War, even though you can list all the countries that were directly involved in World War II, there were a ton of countries indirectly involved and supporting them, either with sending them weapons, sending them ships, sending them bodies, people to fight in the war, right? Like Mexico was actually sent a lot of, I think, people and munitions, amongst other things, during World War II. Yeah, the history books don't really talk about that, but that is what the pull that your allies have, right? So it's very interesting to me when we talk about the global currency and everything, and we look at these where the powers are. It's number one versus number 2 and 3, but also we have a lot of close allies that are kind of in the top 10, top 15, right? The key is, there are allies now. Are they going to be our allies when we need them? Or is China going to try and steal them away? We shall see. Okay. She goes to the share. Oh, here's a good chart. God, that is good. The share of the world military expenditure of the top 15 countries with highest spending, and she puts in a pie chart. And the U.S., if you can't see this, is about 1/3 of the pie chart. China is about 1/6, 1/8, give or take, and everybody else has just a small sliver, like maybe around 5 to 10%. And again, this is the expenditure, not necessarily the size, but how much money we are spending on it. So the U.S. has got 38%, China's got 14%, and the others are in the 2 to 3, maybe 4%, right? All right, so that's something to think about on the dollar. All right, euro-dollar market. So not a requirement of the reserve currency, but we have to factor in euro dollars, as this is one of the world's primary international capital markets. So what is the euro dollar? The euro dollar is not all the dollars in Europe. I know the name makes you think about that, but it is not that. What the euro dollar is all of the dollars that are in the world in the world being transacted outside of the US. Well, why does that matter? Who cares about counting it? And we're going to get into that. The term euro-dollar refers to the U.S. dollar denominated deposits at foreign banks or at overseas branches of American banks. Because they are held outside the U.S., euro dollars are not subject to regulation by the Federal Reserve Board, including reserve requirements. Dollar-denominated deposits are not subject to U.S. banking regulations, where originally held almost exclusively in Europe, hence the name euro-dollar. Now, they are also widely held in branches located in the Bahamas, the Cayman Islands, etc. So basically, why does this matter? Because we can't track it. We don't know what's happening, okay? Inside the U.S., through large brushstrokes, we can see how much credit card debt people are into. We can see how much people are spending, where their savings account is. We can track not to a precise amount, but in a large brushstroke, giving us a good chart or idea of where things are going, where the dollars and what's happening to the dollars inside the U.S. The issue is there's a lot of dollars outside the U.S., right? And the Federal Reserve has no power, no authority over those. And so we don't know what's happening. Are they just sitting in the bank? Are they being used to purchase treasury bonds and then going back over there? What's happening? Where are they going? We don't know. So we have to factor that in. The fact that the euro-dollar market is relatively free of regulation means such deposits can pay higher interest. Their offshore markets make them subject to political and economic risk in the country of their domicile. However, most branches where the deposits are housed are in very stable locations. Yeah, here she goes. This is Tracy's thing. To say this market is huge is an understatement. In 2016, the euro market size was estimated around 13.83 trillion, and since grown. That's in 2016. Another reason why this is so important, right? Because the euro dollars can have pull on the US dollar and vice versa, right? So if a bank outside the US says, hey, we're going to offer debt in the form of dollars. Let's say they say, hey, we're going to give you $1 million to buy that nice European home or whatnot, right? And that is debt created out in the Eurodollar system, but outside the US system, right? Where's that person going to get the dollars to pay the debt back? Well, it's going to have pull on the US because that's where the dollars originate from, right? Unless it's a debt denominated. So if they say, okay, we're going to run our business, let's just say they're farmers or whatnot, and they farm, they're wine, let's make it classy. They are French wine vineyard owners, yes, and they have purchased this wonderful countryside villa for $1 million from the bank for dollars in France. And they're saying, hey, we're going to use the proceeds from our wine sales to pay back the dollar amount, right? They're going to sell their wine, get euros, because they're in Europe, right? And they're going to change those euros back in for dollars from the US. They're going to pull dollars out of the US, right? And to pay back that loan. Or they're going to sell their product straight to the US and pull dollars out of the US into France to pay back that loan. What does this mean? This means there are less dollars circulating in the US, right? Because they're circulating outside the US. What does that mean? Well, that means dollars inside the US are harder to come by, right? What does that mean? That means the value of the dollar goes up and everything else falls. Makes sense? Now, with this one example of $1 million in France, it doesn't seem like a big deal. You times that by 100 million for everything that's happening around the world. If it all happens at the same time, you get a huge pull on the US dollar, taking it out of our local economies in the US and being pulled overseas. What does this mean? Well, how do you control this, right? How do you stop from the US, because of all the dollars being pulled overseas, from going under? Well, you print more. This is one of the reasons why they're printing so much, because they don't want the dollar. It's this thing of the dollar being too strong that it will break itself, and so they're printing more to try and weaken it down. At the same time, it weakens the dollar here in the US and makes everything else fly up in pricing. The moment they stop printing dollars in the US stateside and shipping them out overseas is the moment the dollar strengthens so much, and it's going to cause everything else, assets and everything else, to fall. And it's going to be a great buying opportunity, by the way. So, all right, let's see here. All right, in summation, right now there are just no other viable country with the ability to supplant the US dollar as the global reserve currency, taking all these factors into account. So Tracy says, hey, the US is going to be on top. There's no other country that has all the things to supplant it. Data last week showed some signs of the economy slowing. So let's go into the labor market. ADP private payrolls report for the month of March showed an increase of 145,000 jobs, well below the expected 250,000 jobs increase. So ADP, that is a payment company, and they're very large, and they will print their payrolls. They make them publicly known, right? So this is how we can take a step back and in a broad brushstroke look at the U.S. economy and see how things are going, right? Just a little indicator. So if ADP says, hey, every month we've got $250,000 increases in jobs. In other words, there's 250,000 more jobs that we're doing payroll for. Well, that's good. That keeps the economy on keel, right? If it's 300,000, that means, hey, there's more jobs. If it's 145,000, the expectation was 250, that means the labor market is starting to pull back, right? There are less new jobs being created. The report also noted that the pace of wage growth decelerated from the February report. In addition, the job openings data last week, JOLTS, showed that the openings in February fell below 10 million for the first time in nearly 2 years. Another signal the labor market may be cooling. Manufacturing. Last week's data for the U.S. manufacturing activity and services activity for the month of March came in well below expectations. The ISM Manufacturing Index, is a gauge of manufacturing health, fell to a nearly 3-year low of 46.3, below the expectations of 47.5. Readings below 50 indicate a contraction in activity. Similarity, service indexes coming in at 51.2, below expectations, 54. Although still slightly in expansive territory, the manufacturing service indexes are considered leading indicators of broader economic growth and are showing clear signs of slowing, which indicate a slowdown in the economy ahead. Okay, what does that mean? We manufacture stuff. Manufacturing is a good headwind, not tailwind, of what the economy is going to do or what's going to happen in the future. If the economy is booming, what is going to happen? You're going to buy more stuff, right? Either for your business to supply, or you're like, hey, I got money, James. I'm going to go buy me some houses, some cars, some boats. All that stuff needs manufacturing, right? Whether you're cutting the wood, you're making the shingles, you're doing the cables for the copper for the house or the cars or the boats or whatever, it all needs manufacturing, right? So when business is booming, when the economy is growing, manufacturing goes up and increases, right? As the economy increases. When manufacturing starts to slow down, that means there is less demand, right? Less demand means the economy is probably going to slow. So what they're saying is, hey, it started to slow a little bit. This could be a sign, could be a headwind, not a tailwind of the slowing economy, right? Because people are buying less. There's either less money for them to spend on it or less confidence in the market. Either one could slow everything down. Housing. This is going to be a favorite for a lot of you. Over the past couple of weeks, we have seen housing data come in softer than expected. The housing and rental components of inflation have remained elevated, although the real-time data indicate a housing market that has started to soften. Last week's Case-Shiller National Home Price Index saw moderating gains for 7 straight months, coming in at 3.8% year over year, which has not been seen since the pre-pandemic period. Number one, higher mortgage rates are cooling because housing demand. Let's start over. Higher mortgage rates and cooling housing demand have weighed on the sector, which could also see further downside if mortgage lending standards tighten. From Edward Jones. All right. So she goes over the technical. She's got a chart with Case-Shiller and a 30-year mortgage. They don't really seem to have a lot of correlation, but you see mortgage rates going higher and Case-Shiller bumps up and then flies down, right? Mortgage rates aren't set by the Fed. Case-Shiller is more of a feeling of the buyer side, the sentiment, right? Last week, she says, I noted, I think likely we're open to gap. Okay, so we're going to go over, we are switching to oil, okay? But let's wrap up. Basically, Case-Shiller is a big thing. He came out at the end of the last housing crisis and is used as a good bellwether. Again, a lot of these are on the front end. That's why I call them headwinds. These are saying, hey, in the next 12 to 24 months, these are indicating things are not going on an upward trajectory, right? They could go down. It'll probably take, if they keep on this trajectory, it'll probably take 12 to 24 months before we see a really big collapse or like the bottom of a collapse, just depending on how fast things go. All right, let's move to oil. Last week she said, I think likely we open gap up tonight on the OPEC news cut. So she's referring to OPEC said, hey, we're going to produce less, and some other countries did. I mean, it was, I think counting all, it was like 1.06 or 1.6 million barrels a day, which is actually quite a large amount to move a dial. And to gap up, she's talking about in the stock market, which we'll go through we'll look at a chart. I think likely we open gap up tonight on the OPEC cut news. That being said, we are getting close to being overbought overall. The market is still constructively bullish as the recent lows may be for at least the next few months. We have, as we head into high demand season and China recovers. So China's been opening up back their manufacturing and such. And what happened? Gap up indeed. That said, we are well overbought. I'd like to see some bullishness worked off and continue to go higher. So far, the Biden administration has been fairly quiet about these new cuts. We may hear some announcement this week. It could be they bring up OPIC. It could be another SPR release, export controls, horrible decisions, or perhaps nothing, but it could just be on the lookout for news that may drive it down a bit. So right now, oil and gas, it's not following fundamentals really, but it is whatever the news is going to push it up or pull it down, right? So a great example is the the OPEC cuts, right? They weren't producing that much anyway, but they finally came out and said it, and then oil it flew up like $10 in 7 days. Man, it is going up, up, up. Here's the thing that she's saying. They could bring up OPEC. It's probably not a good idea if she's saying they could say another SPR to release, which is the Strategic Petroleum Reserve. Help us all, because that is going to be very bad for the U.S. I did in other videos. Make a comment and I can tell you, or I can make another one. Or export controls, another terrible decision. I've done that in a video or two. Long story short, with this one, not all crude is the same. We trade it to get the crude that we need, or to blend it, really, or perhaps nothing at all. But either way, so this is a gap up. This was basically the price action, and then on Friday, and then Monday it flew up. Right, so right now she's saying, hey, we're a bit overbought, we're a bit at a high, expect oil to come down a little bit, and then most likely will shoot up again. From what I'm hearing from all the big wig talking heads and the people that are in the know, is that oil is just going to go up this year, right? It's going to have some stuff like this where it comes up, goes down a little bit, then comes up higher, then goes down, then comes up higher, and goes down, comes up higher. It will do that until the recession hits and everything is pulled down. And that will be sometime at the end of 2023 or early 2024. But then once that happens, once that pullback happens, it'll just go up again. And it should end up on another high in 2024. That is the estimation currently with all the information we have. Now, a lot of things could change this. A world war could change this. You know, more production cuts could just send things through the roof. There's a lot of things that can happen, but what's not going to happen for very long, or hopefully not at all, is things like the SPR release that just dumps a bunch of oil in the market, try and cool it down. That's just not going to do. We only have so much of that. You can only withdraw so much out of your piggy bank without it running empty, right? So the fundamentals for oil is that we're not producing enough. We don't have enough. The price is gonna go up, right? So jump in and join me today. We're making tons of money on it. Natural gas, no change in my view from last week. Market, it still looks terrible. I'm going to skip this a little bit, but basically nat gas, a lot of people are thinking it'll probably start going up again late this year if it does. Long story short, Europe lucked out, and so gold last week. Gold was in consolidation week. This actually speaks gold strength, as it did not tank with the markets rallying. Maybe on the side of the market, but overall the chart says bullish. A lot of people are saying that, and a lot of foreign nations are buying gold, so that tells you something. And she says, well, we actually broke to the upside last week after 2 weeks of consolidation, a bit overbought, but overall still bullish. So with a lot of commodities, let me take a step back. With every recession or depression, right, it can pull everything down, but some pulls more down and shoots it up, right? You have bull cycles and bear cycles. So what a lot of people are saying is that in the late 1990s, early 2000s, that was the tech bubble that popped, right? So if you bought Amazon or something, then it just shot up over the last 10, 20 years, right? 2008 to 9 and 10, that was the housing market. That bubble popped, came down, right? More than everything else did, right? So it was a great time to buy real estate. What I think is happening in 2020 was that it was a materials and what am I trying to say? Materials and commodities cycle, right? That would pop down, the early 2020 pop down commodities, and now commodities are going to start their super cycle, okay? Real estate just had its, right? If you bought any piece of property between 2000, depending on 2008 or 9 to 2021, it just went up in value, right? I mean, you could have bought a box and that someone could live in, and it went up in value. Same thing with tech in the late late 90s, early 2000s, right after the dot-com bubble popped. In 2020, it seems like it's commodities that are going to go up, and everyone's saying it's going to be a commodity super cycle for the foreseeable future. Okay, and she's saying that copper's waffling. Last but not least, USD, as always noted, it still looks as though we have a bigger pullback in store. This is a chart for the USD, it seems. This is the chart for the USD. Looks like we're going to pull back. This little line here, I think, is a 200. We'll probably test that. And what a lot of people are saying, we're going to hit that probably around 98, maybe 100, 90, high 97s, something like that, 99. And then it's going to test that and probably bounce higher, pulling everything down. Again, when the dollar is high, it flattens prices on everything else. And so it'll probably go up, and that's when we'll have be fully into the recession. And then after that, it'll just go straight into the ground. Follow me, like, and subscribe for more as we go through this. Again, here's a financial disclaimer. If you're on my email list, you will get a copy of this. I pay for it, so you don't. Thanks for being my fans. Like and subscribe. Leave a comment, and if you want my email list, I've got the information below. Again, my name is James, and this is the giant economy that we are all living through and trying to make just ourselves and our families better. Thanks for joining me in this. And if you think this can be any better or anything else, or left you anything of value, let me know. Love to hear about you. But I'll leave you from this for now. See you in the next video.